Hall & Wilcox acknowledges the traditional custodians of the lands on which this podcast is recorded. We pay our respects to their elders, past and present, and to all First Nations people joining us today.
Hello and welcome to the latest episode in our Tax Records podcast. My name is Todd Bromwich. I'm a special counsel in the tax team at Hall & Wilcox. I'm delighted to be your host for this episode. I'm joined today by Frank Kanopoulos, head of our tax team. Frank, great to have you on.
Pleasure to be with you, Todd.
Today we're exploring the importance of strong corporate governance in managing tax compliance and tax risks. This is a topic that's increasingly on the radar for executives, as effective corporate governance can go a long way to protecting a business from financial and reputational harm. Frank, let's start with the basics. In-house counsel juggle a lot, and why should tax governance be on the top shelf of their priorities?
Three important reasons, Todd. Money, accountability, and reputation. So the first reason, money. We all know tax is a significant business expense, and a single amended assessment can very quickly become a highly material number, especially when you're adding penalties that can go up to 75% and daily compounding interest. A number like that can cause a business a lot of grief and can very quickly start to bite into profit margins. The second reason, accountability. There can be, in some cases, personal liability for directors and public officers, which can arise from them being issued penalty notices. And directors and public officers can find themselves ensnared in a tax audit and even pursued personally by regulators. And thirdly, and this is very important, and that's reputation. Tax controversy can play out in the court of public opinion. There's a long list of examples that one could give illustrating that. And that can all happen long before those matters reach a courtroom. So when the Australian Taxation Office, the ATO, names an organisation in its transparency reports or is in the financial press as running significant litigation against that taxpayer, the reputational impact can be very significant. So governance and hardwiring controls into a business's governance processes and principles is a firewall against those risks.
Okay, so you laid out a few risks there. In your practice, where do you see those risks crystallising most often?
I see it most often in three settings, Todd. The first setting is in the course of what you might call business as usual transactions. And that's basically around payroll, GST, income tax, and superannuation compliance. What happens here is that errors can become systematic. They can become baked into a business's systems, and very quickly a mistake or a wrong position or an error can snowball into a very big problem very fast. The second setting is in relation to strategic tax positions. So what I mean by that is the position that a business takes in relation to its transfer pricing approach and strategy, its application of the R&D incentives, and other areas, complex areas of tax law, including and especially cross-border areas of tax law, thin capitalisation, cross-border financing, etc. These are important, complex positions, very tax-driven, and they are areas that can be readily scrutinised. And the third is in transactional settings. So that's in one-off events like acquisitions, restructures, or IPOs, those bet the company moments that can really draw the ATO's scrutiny.
So Frank, tax law is notoriously dense, as you and I both know. How much of this risk stems from the law itself?
A lot, Todd. As you know very well, we have layers of legislation, we have ever-evolving case law, and we have a constant stream of administrative guidance. Even seasoned tax professionals like you, Todd, can misstep when legislation and guidance starts to diverge or as it starts to evolve. We even see, I often give the example that even Judges, the most seasoned, the most experienced lawyers and tax lawyers in the country, often disagree. A decision of the federal court may be overturned by the full federal court, and that may in turn be overturned by the High Court as well. The complexity of tax law is very much a source of some of this risk for taxpayers, and especially high materiality taxpayers.
So speaking of the ATO, how proactive are they in their compliance activities at the moment? I know we see big changes between governments, and based on how the economy's going, that they can take different focuses in their compliance. But are we seeing a bit of a ramp up at the moment?
Very much so, Todd. So the ATO's Tax Avoidance Task Force has two important attributes. A, it's very well funded, and it's one area where budget for the ATO to undertake its tax avoidance task force activities has expanded. And secondly, it's very data rich. So the ATO run market segment programs, the program for the top 100 taxpayers, the top 1,000 taxpayers, the next 5,000 emerging taxpayer group, which is high growth businesses, as well as what they do in the high wealth space for high wealth individuals and family groups. And they also do what you might call thematic reviews around specific issues like transfer pricing and profit shifting, or in the middle market and property space, capital gains on commercial property and how those capital gains are treated. We also see in practice every day that the ATO can and do obtain data, oftentimes before tax returns and other disclosures have actually been lodged with them. They can match data in real time, and they're very inclined, the ATO are very inclined to test their legal positions quite aggressively, including things like valuations and taxpayers' technical positions on key strategic and material matters. If they ever existed, the days of file and forget are well and truly over now.
Okay, and the ATO, we see often using the phrase justified trust in its guidance to taxpayers and advisors. What does that actually mean in practice?
The term justified trust is one we've been hearing for a while now, Todd, and it's the Commissioner's shorthand for him having confidence that material taxpayers, so large corporates and large private groups, are paying the right tax at the right time and have good systems in place to manage their tax compliance. So to earn justified trust, a company must show that it has a robust tax control framework, and that framework is embedded in its board governance. Certainly not a box-ticking exercise. The ATO reviews the effectiveness of a business's governance policies proactively and with regularity, and it can be a significant difference for a large corporate or a private group. And with these things, we'll explore this in a moment, but it really is about implanting effective systems all throughout an organisation.
Okay, so if you were advising a board tomorrow, what are the key elements that you would insist on for their organisation?
I think there's 5 things, and I'll start to describe them. So the first thing is having a clear governance hierarchy. So you want to have a tax strategy that is approved by the board. You want to have a documented risk appetite that will become a guide for the taxpayers, the position the taxpayer will take on material and significant tax issues. And you want to have, as many organisations do in different contexts, a delegated authority matrix. The second thing that a well-governed business from a tax point of view is going to have is integrated processes. So you want to have tax embedded in finance and commercial workflows. The goal of that is to try and achieve front-end detection of tax issues and tax risks and not be behind the 8 ball and having to patch up matters after they've occurred. The third thing is you might describe as control testing. What that means is the business running its own regular internal audits of its processes, of its compliance, obtaining independent reviews of material tax issues as well as its processes, and that's what you and I do, Todd, as well as having a handle on and regularly assessing its own data, its own performance from a tax point of view, and where that might start to raise red flags, start to surface some risks. The fourth issue we can describe as issue escalation, having within a business, and again, businesses have this in different contexts for different risks, but define thresholds and events for notification to be made to the CFO, to the Audit and Risk Committee, and where material, to the board with a view to engaging with the ATO. And the fifth and final element of a robust tax governance framework is the right skills and the right culture. So having tax competency as part of the organisation's ecosystem, whether that's internal with an internal resource, but not every business can have that. So it's often engaging with the right external advisor, external accounting firm, etc., and making sure that an awareness of tax and tax risk starts to permeate all facets and all elements of the business through HR, through treasury, through finance, through everything else that can affect the business's financial and tax positions.
Okay, so picking up on your point there about internal resourcing, where does in-house legal fit into this ecosystem?
In-house legal is very important, and you might call it the connective tissue of the organisation that joins corporate governance and ATO compliance. So in-house counsel, in terms of what they do, they interpret legal risk, they can ensure that legal professional privilege is preserved where appropriate and where it should be, and they can drive a sort of cross-functional alignment between tax, finance and risk, and really be at the centre and play a pivotal role in helping to hardwire and get these strategies and structures and processes and culture embedded through their organisation. In-house counsel also play a critical role in board reporting, really translating technical assessments into exposures in a way, in a communication style that directors can grasp and get their arms around and sign off on.
So one of the themes you've talked about here, Frank, is managing tax risk. And there's a range of different ways an organisation can do that. And one of them is ATO products like private rulings. Are private rulings worth the effort, and when do you think they're actually appropriate?
Absolutely can be, Todd, if they're used strategically and intelligently. A private binding ruling is a way of obtaining as much tax certainty and assurance as you can possibly get as a taxpayer, subject to the facts that have been stated in the ruling being the facts that play out in real life. A ruling, a private ruling, or in some cases even a class ruling, can really help to de-risk an arrangement from a tax point of view and provide that comfort. An example that one might often see is a class ruling dealing with an employee share scheme plan or arrangement. Oftentimes a class ruling or a public ruling can be obtained to provide some certainty and some risk assurance where a position being taken by a business or a company or a taxpayer can have a flow-on effect to other third parties. But of course, with the process of applying for a private binding ruling, there is also some risk as well.
Okay, so let's assume that these governance procedures we put in place have either failed or something slipped through the cracks, or maybe there's a development in the interpretation of a law, and as a result of one of those things, an organisation identifies a clear error in their tax compliance. What's the playbook?
Well, Todd, you should move quickly, and I think this is what you should do. First, you should quantify the exposure, get a sense of the size of the issue. Second, you should obtain professional advice and an objective view on the issue and the risk exposure that is faced by the business. Third, there should be an assessment of whether it's an isolated issue or whether there is some systemic spread of the issue because it affects lots of different employees, for example, or affects different parts of the business. And fourth, decide on a strategy to deal with it. And that may include dealing with it through a voluntary disclosure to the ATO before the ATO apprehend or identify the issue and come knocking on your door. An early engagement or a voluntary disclosure with the ATO can have very significant benefits. It can substantially reduce penalties, sometimes even to nil. And from the perspective of the ATO, it sends a signal to them that the taxpayer has a culture of integrity and seriousness about its tax compliance, which is exactly what the ATO wants to see and wants to encourage.
Okay, so let's assume there's an issue and matters escalate. What are the unique features of tax litigation that clients and advisors should anticipate?
Let's start by stating the obvious, Todd, and that's that litigation is never a pleasant experience for any person or any taxpayer. But in tax litigation specifically, it can be a bit of a different ballgame. So the first thing, Todd, is that the onus shifts from the commissioner to the taxpayer. What that means is that the taxpayer must prove the commissioner's assessment wrong. The commissioner doesn't have to prove his assessment to be right. Secondly, in running litigation with the ATO, there can be a resource imbalance. The ATO is very well resourced. It is the government. It has unlimited resources practically. And there can often be an asymmetry between information as between the ATO and the taxpayer. And actually, sometimes the ATO may have the upper hand when it comes to information or knowing information about the taxpayer. Third, and while the ATO is bound by model litigant guidelines, which prescribe how it is to act and engage and behave with taxpayers in a litigation environment, there should be no misapprehension that the ATO doesn't litigate hard. And also, and this is a sort of righteous element of the ATO's litigation strategy, that they do litigate strategically to clarify the law or where an issue may have a broader effect on a larger group of taxpayers than just the specific taxpayer who is involved in the litigation. So good preparation from day one is absolutely essential in a tax litigation matter.
Okay, so looking forward, what trends should our listeners keep on their radar?
Now, there's a couple that are important, Todd. The first is that tax and tax governance and compliance is really becoming part of a wider conversation around ESG, environment, social and governance reporting. And in fact, a lot of ESG reporting now incorporates tax transparency and tax disclosure. So there will be a greater expectation, I think, especially for the corporate sector, for greater transparency around tax compliance and governance. The other strongly emerging theme, not only in tax and tax compliance, but just in life generally, Todd, and that is the increased sophistication of technology. The ATO is very adept at developing and deploying tech-enabled solutions to assist with its compliance and detection activities. The ATO has natural language processing tools that can very quickly scan and analyse, for example, contractual documents or terms for tax risk. That really raises the bar in terms of what taxpayers need to be doing from the perspective of the quality of their documents, the clarity of their information, and the way that they should be engaging in material transactions and positions and areas where there might be amplified tax risk.
Thanks, Frank. Let's close with a checklist maybe. If listeners do nothing else after this podcast, what are the main actions that they should prioritise for their business?
Sure, Todd. So I think there's a couple of things that every taxpayer, whether they're one of the biggest taxpayers in the country or a significant privately owned or high wealth group, should be doing. The first is to get a handle on where their governance processes and systems and practices for tax currently sit and do a bit of a gap analysis between where they are today and where they should be in terms of the Commissioner's expectations for tax governance for a group of their size and scale and scope. That's the first thing. The second thing is to map out and understand high-risk tax positions, strategic positions, key transactions, all of the things that we talked about before, and get some board visibility into those high-risk tax positions and just make sure that there has been strong and objective support for that position. And we should also include in that, we've been, as part of that conversation, any significant outstanding debts, because it's very well known and been very well publicised that the ATO does have a very strong and intense focus on recovering debt and getting recovery of long outstanding tax debts and not being used as a bank. And the third point, I think, is to really focus on cultivating a culture where everyone has an interest and a stake in the business's tax compliance, where everybody has some familiarity with the business's processes in terms of tax compliance and is really focused on minimising those risks. It shouldn't be something that is parked or isolated with the accounting team or the finance team necessarily, because, as we said right at the start, Todd, going back to where we started, when these things, when these tax issues go bad, they can go really bad and cause a lot of damage to the business. Start, I think, to feed through, whether it's through training, whether it's through processes to achieve accountability, or whether it's just recognising that a business is a material and substantial stakeholder from the ATO's perspective in the Australian tax system, and just start realigning its practices and behaviours accordingly.
Thanks, Frank. Insightful as always. And thanks for equipping our listeners with a roadmap to tax governance that actually works. I'm sure they will find it useful.
Always a pleasure, Todd. Thank you for having me.
And thanks everyone for listening today. As always, please get in touch with us if you have any questions. You can find our details on our website, which is hallandwilcox.com.au, or connect with us on LinkedIn. If you enjoyed today's episode, then rate, review, or subscribe to our podcast wherever you get your podcasts. Thank you.
This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.